In international trade, tariffs are taxes on imported goods. Governments use tariffs to protect domestic industries from foreign competition. For example, a country might place a tariff on imported cars to help local manufacturers. By increasing the cost of imports, tariffs make domestic goods more appealing. However, tariffs can lead to higher prices for consumers and retaliatory measures from other countries. Understanding tariffs is essential for grasping global economic complexities. The Trump presidency saw heightened trade tensions, marking a significant shift in U.S. trade policy. With significant tariffs on goods from China, Mexico, Canada, and the EU, the administration aimed to reduce the trade deficit and bring manufacturing jobs back to the U.S. Aimed at protecting American jobs, these tariffs sparked retaliation and trade disputes. Many American businesses and consumers felt the impact as costs rose and supply chains were disrupted. Notably, Trump imposed a 25% tariff on steel and 10% on aluminum, affecting many countries. These measures were justified as necessary for national security. Close allies like Canada and the EU responded with tariffs on American goods, leading to a complex web of trade negotiations and economic tensions. The trade war with China involved tariffs on hundreds of billions of dollars worth of goods. This prolonged conflict affected global supply chains and created uncertainty in international markets. This tit-for-tat escalation disrupted global markets and raised prices for businesses and consumers. The ripple effects were felt worldwide, influencing economic policies and trade strategies in numerous countries. Tariffs often lead to higher prices for consumers. When governments impose tariffs on imported goods, the additional costs are typically passed down the supply chain. This means that retailers and businesses have to increase their prices to cover the extra expenses. When a tariff is imposed, the cost is usually passed on to consumers. This can make everyday items more expensive, affecting household budgets and spending habits. For instance, tariffs on Chinese washing machines increased their prices in the U.S. This led to a noticeable hike in the cost of these appliances, making them less affordable for many families. Consumers either paid more or opted for costlier domestic alternatives. This shift in purchasing behavior can also affect the market dynamics and competition among brands. Tariffs can also raise prices for domestic goods by increasing production costs. When manufacturers rely on imported components, the tariffs on these parts can lead to higher overall production expenses. Higher costs for imported components lead to higher prices for finished products. This means that even goods produced domestically can become more expensive due to the increased cost of materials. This ripple effect impacts a wide range of goods and services, from electronics to clothing. The increased costs can be felt across various sectors, ultimately affecting the overall economy and consumer spending power. Tariffs create both winners and losers among American businesses. They are a double-edged sword, offering protection to some while imposing burdens on others. Some industries benefit from reduced competition, gaining a stronger foothold in the market, while others face significant challenges and increased operational costs. American steel producers welcome tariffs on imported steel, boosting domestic demand and allowing them to expand their operations and workforce. However, industries relying on imported steel faced higher costs, which affected their overall profitability and competitiveness in the global market. Manufacturers of automobiles and machinery saw profit margins shrink or had to raise prices, making their products less attractive to consumers. This ripple effect can harm downstream industries and lead to job losses, affecting the livelihoods of many workers and their families. The impact of tariffs is complex and varies across sectors, creating a landscape where the economic outcomes are unpredictable and multifaceted. Trump's tariffs had mixed short-term effects on the U.S. economy. Prices for consumers and businesses increased as tariffs took effect. Higher costs squeezed profit margins and contributed to inflation. Retaliatory measures from trading partners led to escalating trade disputes. Countries like China, the EU, Canada, and Mexico imposed tariffs on American exports. American exporters faced reduced demand, leading to job losses and economic hardship. The immediate impact of tariffs was felt across various sectors. The long-term economic consequences of Trump's tariffs are debated. Some argue tariffs could lead to a more resilient American economy. Others believe tariffs disrupt supply chains and raise prices, harming growth. The impact depends on trade dispute duration, business adaptation, and policy responses. Monitoring the economic landscape and adjusting policies is crucial. Balancing potential benefits and mitigating negative consequences is key. Understanding international trade and tariffs is crucial in today's world. As consumers and citizens, we feel the effects and have a stake in economic well-being. Staying informed helps us make better decisions and engage in meaningful dialogue. Knowledge empowers us to navigate the global economy and work towards a prosperous future. Please subscribe, like, comment, and share this video.